So hello and welcome to today's webinar, From Rapid Relief to a Sustainable Recovery. I'm really pleased to be introducing this event. I'm not going to say good morning or good afternoon or good evening because we are actually crossing continents in this event, and I'm very pleased to have a fantastic lineup of speakers coming from a multitude of different time zones. My name's Kate Levick. I'm the Associate Director for Sustainable Finance at E3G, and I've had the honour of being the lead person on this collaborative project that a team of people from across several organisations has been running for the last year or so. It's a collaboration between E3G, CEAS, and the SOAS Centre for Sustainable Finance and the Bennett Institute for Public Policy. And this is our last webinar in the series of this project. So we'll be reflecting on a year of responses to COVID-19 by central banks and financial supervisors. I'll give a very quick introduction to what this project has been about before I pass over to our host today. So the original question we set out to answer was, how can the responses of monetary and financial authorities to the COVID-19 crisis support social and environmental sustainability? And in the context of that question, we have been able to run a number of different webinars over the last year, which have come from a range of different perspectives. We focused on responses in Europe, in the United States and the Americas, and in Asia. And we're very pleased that we have all those perspectives represented today. And if you could just go to the next slide, please. I just wanted to say a massive thanks to the project team, which has worked on this. It's been, a really rewarding collaboration, which is not quite over yet. We will be producing a final project output in due course and hopefully quite soon. I'd also like to say a big thanks to the Inspire Research Network, which has funded this project and been very supportive all along the way. So having made those introductions, I'd like to formally hand over to the chair today, Ulrich Volz, who's been a key figure in this project. He's the director of the Centre for Sustainable Finance at SOAS University of London. Thanks very much, Uli.
Thank you so much, Kate. A warm welcome also from my side. It's my great privilege to be your moderator today, and I have now the great honor of introducing our keynote speaker, Mr. Ronaldol Numnoda, the Deputy Governor for Financial Institution Stability at the Bank of Thailand. Mr. Ronaldol has had a distinguished career at the Bank of Thailand, which he joined back in 1997 as an executive in the Reserve Management Office. And he has since held numerous very senior positions at the Bank of Thailand before being appointed as Deputy Governor in 2018. And the Bank of Thailand has been very active in the area of sustainable finance over recent years, addressing the climate challenge. And so I'm most delighted that Ronaldol is with us today to first give us an overview of how the Bank of Thailand responded to the crisis and how it is increasingly taking sustainability considerations on board. So without further ado, I'd like to give the floor to you, Ronaldol. Thank you so much for being with us. The floor is yours.
Thank you for a very kind introduction from Mr. Enrich. Anyway, good afternoon and good evening to you all participants in both from the UK and from Southeast Asia time zone. Well, with this common way of creating nowadays, I think it reminds us of how the COVID-19 not only has shaken us the way we live, but it's also shaking the financial stability around the globe and underscore the uncertainty and complexity of our economy. I believe the topic of this virtual event today stands at the heart of us, the central bankers and supervisors. Anyway, I would like to thank the organizers of this virtual event led by the research partnership of E3G, the Center of Sustainable Finance of SOAS University of London, the Citizen Center, the Bennett Institute of Public Policy, as well as Inspire, for inviting me for today to share with you some of our reflection from the point of view from the Central Bank of Thailand. Anyway, this is a guest. As much as we are fighting for this severe impact of COVID-19, we have to look ahead to build back and take this opportunity to regain the seeds of resiliency into our economy. Sustainable recovery is not really an option, but it is our job to decide how to achieve this goal. So in that regards, today I would like to first reflect some of our thinking behind our response to the COVID-19 over the past year. And then I will share with you on how we are preparing for the future. In the case of Thailand, and similar to any country at that, we have been hard hit by the COVID-19 outbreak, especially for the small SME, which are the backbone of our Thai economy, which is account almost to 80% of our GDP. Last year, where the situation was still uncertain, the Minister of Finance, together with the Bank of Thailand, has issued a package of measures to support liquidity to SME and corporate to what we call the loan payment holiday for 6 months for SME, as well as providing soft loan of more than 500 billion baht to SME at the rate of just 2% per year. And for corporations, we have been establishing what we call the Corporate Bond Stabilization Fund to provide liquidity to the firms. This has helped to prevent the panic sale of the corporate bond during that difficult time. But this year, as we all knew, the COVID-19 hasn't stopped and is still spreading throughout the globe. Even though we have seen an early sign of recovery in some sector, but this recovery is still likely to be uneven. The prolonged uncertainties, especially the resurgence of the COVID-19 cases in the second quarter. Some businesses fight hard to continue their business, let alone additional loan or restructuring their debt. Under that circumstances, we have launched 2 more measures to ensure distribution of liquidity to the affected groups in a target manner, reducing their debt burden and supporting economic transformation in the period ahead. These measures include, first, the loan facility for business to support viable SME. This is the expansion of the pool of eligible borrowers, as well as expanding credit limit and loan tender, and amending the interest rate to better supporting business recovery. Second, the debt restructuring through what we call the asset warehousing with a buyback option from the borrower, which allow business to suspend their debt payment and transfer property asset such as the loan collateral to their creditor temporarily. Such schemes would shield the business from having to file sale collateral and provide opportunity to continue their business to their recovery. The Bank of Thailand will support the program by providing low-cost funding at only 0.1% per year to the financial institution. These measures help to provide supporting firms that are experiencing excessive high debt burden, but still viable over the long term. They are also for a longer term horizon to ensure continued economic recovery, as the pandemic has a much longer impact than we have first thought. Distinguished guests, these are the rapid measures to help our economy endure a rough wave of the pandemics. The much awaited vaccine rollout has been key to the fighting of the COVID-19 pandemic itself, as well as the economic crisis. But I would like to stress here that in the same way that vaccination are the key to helping the impact of the pandemics, it is equally important that we should also develop what we call the vaccine for resilience to build immunity against the uncertainty of the world and toward a sustainable recovery. In a nutshell, I personally believe that this simple means building a better today will bring out the best of the future for our next generations. And in that regards, I would like to touch on 2 points that we at the Bank of Thailand has been focusing on, which is an inclusive and green recovery. First, on building back an inclusive recovery by leverage on technology especially focusing on SME, who are the backbone of our economy. While we have been working hard to provide rapid relief to SME, we also have been focused on embedding adaptability and agility into their business upon their recovery. One key enabler is the digital technology to SME, which could open up their possibility and opportunities. Our work for the past year is building digital finance infrastructure has served us well during this difficult time. The innovative real-time retail fund transfer infrastructure to the Thai QR payment, and we call them a prompt pay, has enabled us, the user, to send and receive funds with free of charge to mobile banking and other means. And this prompt pay has enabled firms to continue their business, especially when an e-commerce platform become mainstream. So far, there has been around 57 million prompt pay account registration, which is quite huge, giving our population of around 65 million. Going forward, we are extending our digital infrastructure to help improve efficiencies and inclusion to the financial system, and even more to the micro SMEs. We are building our ecosystem that can be better use data to benefit the customers. We have promoting lending that is based on alternative data. So it could be served people who do not have access to credit using traditional data. Another exciting project that we are launching and driving is building a digital factoring ecosystems, which aims to allow for SME to use their invoice for digital, apply for loan, and get access to liquidity more quickly. Indeed, the technology is a powerful tool and crucial key to building back an inclusive recovery. Now, turning to my second point, embracing the green recovery. For a country vulnerable to climate change, such as Thailand, we have been affected by a number of climate-related incidents, which have been result in a massive financial loss and thus threatening the stability of the financial systems. As such, ensuring that the Thai economy is resilient to the climate-related risks and continue to have sustainable growth is now considered a significant role for the Bank of Thailand. And we have been put this as one of the priority in the strategy for next 10 years for the central bank. At May wonder if climate policy change is a mandate of central bank. I will have to say that as a central bank, we have to ensure the stability of the economy, and that is where the climate change policy has come to play. In that regard, financial sector has a key role in building these resiliencies. First, the financial institutions themselves need to be resilient and need to achieve that they have to access and manage these climate-related risks, mitigating the impact of their lending portfolio. Second, since financial sector play a crucial role in resource allocation, there could be a key mobilizing funds to sectors that are conducive to green recovery. Therefore, these have been our two overarching objectives. First, the mitigation of the climate-related risks on the financial system. Second, we are like to promoting the sustainable finance product and services. In doing so, we have been actively engaged and encourage the financial institution to conduct business responsibly, internalizing the environment, social, and government, what we call ESG, into their considerations. The Bank of Thailand has recognized that the financial institutions are at a various stage of climate-related developments. So as a Bank of Thailand, we started off as a facilitator, opting for an industry-led approach to allow for flexibility toward the standardizations. We have focused on increasing awareness in the financial sector. We also have collaborating closely with other financial regulators to set aligned policy direction. At the moment of kick-ins, we are now in the roles of what we call accelerator, creating a conducive ecosystem for financial institutions to comprehensively internalizing the climate change risk into their decision making. The key is that they are develop their standards and data available to access climate related opportunity and risk. So we are in current development of standardized tools and templates such as financial disclosures, taxonomy, the climate scenario analysis, as well as stress testing that can be used across the industries. Standardization is not only crucial at the national level, but also at the regional and international level. Given the significant amount of cross-border trade and financial flows, as well as the interconnected supply chains, we have joined hands in hand with our ASEAN community to create what we call the ASEAN taxonomy to serve as an overarching guide and a common language for the ASEAN economies. This is to ensure alignment of standards across the region, make it easier and more practical for both investor and business, as well as financial institutions to adopt sustainable finance. Now, while hard rule setting is currently not our priorities, going forward as the financial industry become more ready and better equipped, I believe we could step more into that territory of design regulatory and supervisory framework for the climate change and sustainability. So these are the key areas of our work for building sustainability in financial sector, focusing on both the strategy sides as well as on development sides on the financial system. Distinguished guests, we acknowledge that the road ahead is not easy. People awareness is a sustainability issue, especially during the pandemics. Capacity development to handle new areas of sustainability knowledge and broader cooperations among key stakeholders, be it the financial sector, the business, the policymaker, as well as the academia, are keys to the successful path to the sustainable recovery. In this regard, we truly appreciate the work from all the stakeholders, especially from the INSPIRE, as a research network to support us, the central banks and supervisors, in managing a transition to a sustainable recovery. Today's events serve as one of our important initiatives, bringing people together from both the public and the private sector to exchange views and plan for a better future. I totally wish you all a fruitful discussion in this virtual event today. But anyway, thank you very much for your kind attention. So I pass back to you.
Thank you so much, Ronald, for this excellent keynote speech. I think it's very impressive how you've very comprehensively set the scene, how you've told us what the Bank of Thailand has been doing already. But
I admit to you, there's still a lot more to do. This is just you know.
That would have been indeed my second part of the response. Of course, there is so much more to do, and that's also a question I want to pose to you. I mean, you've highlighted a number of really important initiatives. For example, you've highlighted your efforts to build the digital infrastructure that should also in particular support SME development. And there are important synergies to be gained also with respect to sustainable digital finance. You've highlighted in general the need to build more resilience, not only into the financial system, but also the role of the financial system in helping the economy at large to strengthen resilience. And I very much liked how you described the role of central banks as accelerators for aligning the financial system with sustainability. And I think that is really important to have senior central bankers to emphasize this role, because, as you know, it's not that long ago that relatively few central bankers were keen on discussing sustainability issues, and you've made very clear how core that really is for your mission. But you also now just said, well, this is only just the start, so there's a lot to do. If you can highlight some priorities that you want to push forward now, and also where do you see some key bottlenecks? What are the main issues, challenges holding the Bank of Thailand back in kind of accelerating this mission?
Thank you for the question, Ulrich. I think the past 2-3 years that we are in a challenging difficulty is probably on make all the financial institutions on board on the climate change issue or the ESG issues. I think they're not realizing that this is something very near to us in terms of the risk. I mean, is something that they are thinking that is beyond their control. I think they're thinking that this is not something they have to deal with. But one we have been talking to them that the climate change, the ESG issue is something related to financial risk. I think this is something they are now on board and try to somehow having from the top. I think is the key measures. Like if you're not getting buy in the management, buying from the board, from financial institutions, it's going to be a very difficult path to engage them, to try to facilitating them, as I said, and now become an accelerator. Try to say, hey, this is something very next to you in terms of the risk, not only credit risk, the market risk that you traditional thing that the bank are in those kind of exposures, but the climate change are related to every risk that you are confronting at this moment. So I think first challenging is to engage them to buy in the concept of climate change and the ESG into their risk management and in terms of awareness. I think that's the key. And second, probably have to do is set a sample. I think when you look at the industry and ask us, so what the Bank of Thailand is doing, so that's what we have to set a sample as well in terms of carbon footprint, in terms of doing investment portfolio, in terms of reserve management with related to the ESG concept, for example. So we have to set example to the industry as a facilitator, as an accelerator as well. Not only just walk the talk, but do it for them, to look at them and go together.
Yeah, no, I think that is an absolutely crucial point, and I think the signaling role that central banks can assume and kind of the leading by example is indeed a very important part. Maybe just one question on capacities. So climate risk analysis, kind of the whole area of sustainable finance is for many financial institutions, but also for central banks and supervisors, a relatively new area, and this appears to be a major challenge. Maybe you can say a little bit on what the Bank of Thailand is doing.
Yes, this is a very good question. I think for everyone, especially for the emerging countries, I think the issue of the climate change or the ESG related issue are quite new to us compared to developing countries. Building capacity is not an easy one, I admit to you. But to make a commitment to this issue, we decided to set up a unit, 100% full time or full staff dedicated for this climate change related risk, and hopefully with the capacity built up and with the network that we getting from you and from everyone that have been far ahead of us, learning from them are going to be something that we can, adapt it to our country. So capacity building for the Bank of Thailand is challenging, but capacity for the Thai financial industry is another challenging as well. So yes, but dedication, commitment, I think is a key, and then set a sample as set up a unit fully dedicated at the Bank of Thailand is as one of the sample that we are committed to this issue. And as I said, we have used this set up as one of the strategy of the sixth strategy at the Bank of Thailand to drive in the next few years. So this is something that we are building the capacity, building the awareness to industry as well.
It's great to hear this commitment to leadership in building the capacities to address climate challenges. And if I may add, I've had the pleasure of interchanging with your climate team, and I think you have built something really good there. And
but sadly, I mean, with the COVID-19 in the past 2 years has delayed some of our progress a little bit, because the focus is, as I said in my first part of the speech, is focused on the short-term relief of people who have been affected by the COVID-19. If not of the COVID-19, I think we can make a little more progress. But anyway, as I said, we have to commit to this, and then it's got to answer for sustainability for a long term. But yes.
Right, but all the more important that we now look ahead and really make sure that we use the time in the best possible manner to really advance this agenda. And this is now a perfect segue to the panel discussion. And I'd like to invite all the panelists to switch on their camera so that we have everyone visible. And I would like to very much, before I do that, I would just like to again thank you, Ronaldol, for this excellent keynote speech and for being with us. And I think you can stay with us a little bit longer, but you'll have to drop out at some point. So thank you so much. And
thank you, Enrich. Thank you.
Much appreciated. And now I'd like to invite our different panelists to make some brief intro statements. And I'd first like to invite Mangal Goswami, who is the Executive Director of the CSEM Center, which is the Southeast Asian Central Bank Research and Training Center in Kuala Lumpur. And Mangal and his team actually also have been starting to engage in capacity building on climate change, and as I happen to be involved in that as well, next week with the Bank of Thailand together. But Mangal, may I ask you to give us your take on the responses of central bank supervisors through the crisis to date, and also the challenges ahead? Great to have you, Mangal. Thank you.
Sure. Thank you, Ulrich, and thank you to SOAS and E3G and the Bennett Institute, along with the Inspire Network. I think there's a lot of good work going on together in collaboration with the CSEM Center, and also my colleague Aziz Durrani, who has been part of this team. So again, DG Ranadol, who represents our constituency and is in the frontier of this journey of towards climate change and building resilience, I think has already highlighted a lot of the specifics as to what central banks in our region are doing. But let me start with, I'll give you some, I'll be very brief on some of the key areas. So let me start with the counterfactual. If this massive counter-cyclical policy, financial, fiscal, and monetary were not undertaken, we clearly would probably be in a global depression and not just a deep recession. The whatever it takes has been very effective. However, the big question looms, and it's lurking in the horizon, is about sustainability as the tide of policy support is withdrawn. We are already seeing in our region, in the emerging markets and developing Asia, many rating agencies as well as the financial analysts are already revising their forecasts of impairments in the financial assets going forward. And this does not bode well for the real economy, because, as you know, credit is the lifeblood of the economy. And if their banks start to move on being more cautious in lending because of potential impairments, then the real economy will be impacted. Of course, regulatory forbearance also, on top of policy support, this whole thing may be masking some of the underlying vulnerabilities, and therefore this is something that can impair our growth going forward. That said, sustainability question is not just about growth. It's not just about debt dynamics. It's not just about financial system. It's a holistic concept, and it actually also brings in this whole lesson from this pandemic that we need to build and realign public policy frameworks to build more resilience to systemic hazards like the climate risk that is impending. So how are Asian economies doing on this count so far? Well, as DG Ranadol pointed out, this journey is just beginning, and it's at the very early stages. What we have seen from many countries in the region is at the very highest level from the public policy standpoint. There are national strategies that are being undertaken for adaptation and mitigation of climate risk that is anchored pretty much on the Paris Climate Agreement. We know China, South Korea, India, the ASEAN, Bangladesh, and the likes, they're all in the mix, and they have all national strategies. What this does, of course, implementation is an issue, but what this does is it sets the high-level framework and the commitment for central banks and regulators, because we know that these kind of anchors are very important to internalize this kind of a climate risk, because we know climate risk is financial stability risk. Several member banks in the CSIN community have already issued guidelines on building resilience of the financial sector to climate risk. However, we know that building this kind of resilience will actually need for the financial sector to assess its exposures. What is the risk? How do you measure this risk? This is what is just beginning to take shape. And we are doing a lot of surveys with our central banks. About 28 central banks have replied to our second follow-up survey. And that's what I will provide you a flavor of. What we are seeing is that central banks and regulators are developing taxonomies for sustainable economic activities as part of standard setting. This is being accompanied by regulatory guidance on disclosures, because ultimately, if we do not have the taxonomy and the standards and the disclosures, it's very difficult to actually assess the risk, the risk exposure of the financial system to transition risk as well as to the physical risk. So we are already seeing this, and in our survey, this comes out quite clearly that a significant number of central banks have already been developing taxonomies for sustainable economic activities. And DG Ranadol already pointed out, in the ASEAN context, this is already progressing quite well. What we are also seeing is that, the next steps. In order to assess this risk, you need the analytical framework. The analytical framework, of course, one of the key ones is the stress test. What we are seeing is that stress test templates are already being developed, because ultimately the stress test template is what will give us some idea of how the risk transmission takes place and what channels this can propagate to the economy. On this, what we are seeing is about half of the respondents to our survey, the central banks, have already been developing a stress testing framework. So that is very important, because in order to understand the risk exposure, you need a stress testing. Of course, this stress testing on climate risk is quite different, given that you are looking at long horizons, you're looking at a lot of uncertainty, you're looking at asymmetric distributions and the likes. That said, I think something has to be done. And of course, NGFS, Bank of France, Bank of England are the leaders in this. On what we are doing going forward, the CSIN and NGFS, as Uli has already pointed out, we are building capacity for such analytical frameworks. And next week, we'll be starting our first climate risk and financial sector resilience course. So we are indeed, on our way to doing this. And in the survey that we sent out to central banks, we see that there is a huge need for capacity building. And if you want to look at the various dimensions of capacity building, we are seeing keen interest in building stress testing frameworks, in enhancing risk management and capital frameworks in banks to include climate risk. We are seeing huge amount of interest in building capacity on developing an appropriate set of principles-based microprudential regulation. Again, this is all about incorporating climate risk into prudential regulation. So this is all going on. And on top of that, a lot of central banks are actually walking the talk. They are investing in green bonds through their reserve assets. They're also greening their own buildings, retrofitting them and changing it so that they're more environmentally friendly. So this is all happening, but of course, the pace of this has been somewhat hampered by COVID-19. The reality is that even if we can say that this is an opportunity of a lifetime to move with a greener recovery, COVID-19, the reality is that a lot of the fiscal space has been eroded through policies and through help to the segment of the population that is very much needs it, households and corporations, which may not be along the lines of greening the recovery. So this COVID-19 is an opportunity, is a great opportunity, but at the same time, with many of the Asian economies that went into this with a lot of strength, fiscal buffers, financial buffers, have seen a huge degree of erosion, especially of the fiscal buffers. So going forward, the going is going to be tougher, but at the same time, the opportunities are immense. That's my last point here is that I think given the headroom for fiscal is beginning to close in, it is very, very important to get private capital into the mix. Without leveraging on private capital, this enormous financing gap for green infrastructure measured at about 3.1 trillion over the next 10 to 12 years is going to be difficult to achieve. Therefore, we need private capital. Of course, in order to have private capital, you need to have good governance, and ESG has to be part of the overall mix of things. So I think I'll stop there and wait for the other panelists to share their thoughts. Thank you.
Thank you very much, Mangal. I think you gave a very comprehensive review of what happened, but also look forward on what needs to happen. And surely there still is a lot to do. Now, let me directly hand over to Dimitri. Dimitri Zengelis, he's a project leader of the Wealth Economy Project at the Bennett Institute at the University of Cambridge. And he's been also one of the team members of our project. And Dimitri has done a lot of work on sustainable recoveries and building it back better. And I think also on the connection between monetary and fiscal policies. Dimitri, the floor is yours.
Ulrich, thank you so much, and thank you everyone for inviting me here to speak. Mangai just ended by talking about COVID-19 as perhaps affording a huge opportunity to the world economy as it transitions to new sectors and new processes and institutions and technologies. But there's this sort of lingering and underlying concern about ever more restrictive fiscal space post-COVID-19, and I've written quite a lot of that. There's a paper with Nick Stern that we put out a couple of months ago. And I think the point here when it comes to talking about the role of central banks is to look beyond the mandate of central banks and also talk about policy in general, because the key priority for governments and central banks in the wake of this pandemic is to try and adopt a very clear strategic framework for a recovery package that stimulates private capital, because as Mangai just said, it's going to be private capital that will pay for this transition. 1 or 2 trillion a year over the next couple of decades going to be required in additional investments. And all of these investments need to be future-proof. They need to be resilient. They need to account for which sectors are likely to generate innovation, efficiency, and resource productivity, but also competitive advantage in terms of which markets are likely to be growing, and which assets, technologies, processes, and institutions are likely to be stranded and become obsolete. A lot of the industrial revolution carbon intensive sectors are going to be pressured out by hostile policies and also by new innovative technologies that are going to undercut them in terms of competitiveness. And it's that kind of a world that we need to stress test against. And that kind of change, and I've written a lot about this and could talk forever about it, is likely to happen rather quicker than we expect, because there are these self-reinforcing tipping dynamics that mean that once you flip from one network to another, it takes a long time and you think it's not going to happen, and the inertia in the system is very strong and the political economy barriers are very strong, but at some point expectations move very quickly when the realization hits that commercial advantage lies in moving to the new network, which is going to be more productive, more efficient, and more innovative. We've seen that with renewable energy, we're seeing that with cars. Whether you give two hoots about the climate, you're going to get cheaper electricity and better, more productive cars. And that's, the private sector now recognizes that that's where the money is going to be in coming decades. And this is just the beginning. So it's a world of rapid change. So we need to steer investment in the right assets. We're not talking here just physical assets. We're talking about human assets, the skills and tools, but we're also talking about the knowledge capital as well, the ideas, the processes, the institutions that are going to allow us to transition and transition potentially very rapidly to this new economy. And those countries, those players, those businesses that are more flexible in doing that, that have the institutions that can reskill and retool, and I'm sure Nick will say something about the just transition, those that would otherwise lose out from the transition in order to make overcome those political economy barriers, are going to be the countries and the sectors that prosper in the 21st century. So you need a clear vision to restore confidence, boost demand, create competitive advantage, and provide long-term productive jobs in a resilient economy. And this will happen through the private sector, of course. But the important thing is, at a time when everybody focuses on sovereign debt, there's a lot of private debt out there as well. For many companies, high leverage on the back of cheap credit, fostered deliberately by loose monetary policy over the past decade, has meant activities such as share buybacks and large dividends funded by over-indebtedness, not helped by the sort of moral hazard of the great financial crash bailouts in 2008. And so as a result, according to the IIF, the ratio of global debt to GDP reached an all-time high in 2019, and more than 2/3 of that debt is not public, it's private. So, this issue of debt leverage is really, really important, especially as interest rates rise. And let's not forget, we need interest rates to rise if we're to get out of secular stagnation and restore economy to its long-term productive productivity growth, which requires positive real returns and positive equilibrium real interest rates. So it's really fundamental that we focus on investments that are best placed to generate those returns. And there's a responsibility there from the central bank, but there's a responsibility there from fiscal authorities as well. And it really is important that fiscal and monetary policy work together to channel liquidity as savings to grow these productive sectors. The lesson from 2008 is that recovery plans following the global financial crisis just did fail to deliver. Fiscal policy was used very little after the first 2 years post 2008, and the burden of supporting demand and activity fell largely on monetary policy. So we saw quantitative easing employed in many countries and official interest rates being reduced progressively, in due course reaching the zero bound. And the evidence, strong evidence, suggests that fiscal austerity is a drag on short and long-term growth, especially when it's applied to depressed economies, but not only for depressed economies. The case for expansionary contraction that has been made before whereby you enhance market confidence by addressing growing public debt in order to generate faster activity, was found to apply only in very special circumstances where the credibility of fiscal frameworks had previously been called into question. We've seen over the last decade that austerity in the UK and European countries left many budgets little improved well into the cyclical recovery. By comparison, you look across the water at the US, where they had a much more active fiscal stance. The US economy outperformed European rivals, not only in growth, but also as a corollary in securing faster reduction in public debt following the 2008 crises. And there's a lot of academic work that shows that fiscal stimuli during periods of economic weakness improve fiscal sustainability in the long run. So it's really important to set out the clear macroeconomic arguments and the options for fiscal and monetary policy in these times of rapid change. We know that real equilibrium interest rates have fallen close to zero. This reflects a continued low, and this is even post-recovery, this reflects a continued low public sector desire to invest and its counterpart in an abundant appetite to soak up increasing public debt. Despite the rise of borrowing and despite all the concern about fiscal space, the private sector is signaling that it's not worried about fiscal sustainability. It's more worried about generating returns. So there's this changing landscape of risk. There's a realization of where future growth will be, that this growth will be low carbon, it's going to be resource constrained. That's a less risky sector than sustaining carbon intensive, resource intensive sectors of the past. So the question becomes which technologies, which behaviors, which firms are likely to be obsolete in the 21st century, and which sectors and which sovereigns are exposed, and which sectors, on the other hand, are likely to be the most resilient and future-proofed. And in that sense, as I say, central governments and central banks and governments need to act in the same way by credibly leading that kind of change and going with the grain of the change in the landscape of risk. And quantitative easing, by the way, has been a problem. I wrote a paper on this almost a decade ago with some colleagues of mine, pointing out that, of course, the need to invest in liquid, large cap, highly rated stock and corporate debt means that you, by necessity, focus on the backward-looking old economy, and that some account needs to be taken to level the playing field when it comes to quantitative easing. This is not a question of reducing risk for green technologies. It's about equalizing the risk and not actually disproportionately sanctioning green technologies. And Mr. Namonda ended by saying that central banks need to be accelerators of a transition. I think that's really important. As Mangai pointed out, we need taxonomies for sustainable activities. We need standards. We need supervision and regulation. We need to push green financial instruments, and we need to support disclosure and forward looks as part of that stress testing. And those have got to be really ambitious, those stress tests. If you look 10 years ago, nobody in their right mind thought that solar PV and battery costs would fall by 90% over a decade. If you'd said that, you'd be laughed out of court. But that's exactly the kind of change that central banks and private sector investors need to consider as part of their stress testing. It's got to be extreme, and it's got to be slightly crazy. So I'll end there, but my key point here is to say that this is really going to only be credible and effective if support for the transition is carried out by central banks in full collaboration with fiscal policymakers. Otherwise, there will be mixed and muddled signals which will puzzle investors, raise the cost of capital, and delay the necessary transition, and expose a lot more players to the inevitable risk of transition once it becomes clear that the private sector needs to move in this direction. Thanks very much.
Thanks so much, Dimitri, for this very eloquent plea for fiscal and monetary coordination and the need for having some very clear signaling from both the government and central bank. I'm sure we'll get back to a lot of the points you've touched on, and I would like to also invite the audience to put questions in the Q&A function if you have, and we hopefully will have time to return to them later on in the Q&A session. With this, I'd like to invite Nick Robbins. So Nick Robbins is a professor of professional practice for sustainable finance at the LSE Grantham Institute, and he's also co-chair of the Inspire project. So also from my side, thanks a lot, Nick, to the Inspire Network for supporting this Sustainable Crisis Responses project. And Nick, you've been working very closely with the NGFS, with the central banking supervisory community on crisis responses, on what they should be doing. And you've, of course, very closely observed what they have been doing. But also you've been making a lot of important contributions on the way forward. So I'd like to invite you to give us your views.
Well, thanks, Uli, and thanks so much for the invitation to speak here. And it's really good to see this Inspire project ending on such a high, really sort of powerful works from DG Ronadal and also from you, Mangal. I think it was really extraordinary, actually, what is happening. So maybe just a bit of introduction for the audience. So Inspire is a research network that is a research stakeholder of the NGFS, and our aim is to provide sort of top quality research and dialogue which can help and support central banks as they go about greening the financial system. We have now over 30 commissioned projects, and this one is one of those. And I'm delighted to co-chair Inspire. We also, as part of the response to the crisis, delivered a toolbox of crisis response measures, which my colleague Simon Dickow led, and Uli, it was great to have you as a co-author on that. And we're now actually engaged in a new joint study group with the NGFS on the highly related issues around biodiversity loss and financial stability. So that's the area that Inspire sort of fits within. So maybe if I could just build on, because a lot of wise words have been said. So what have we learned so far from the crisis, and where next? So maybe just some insights from this toolbox that we produced first in June last year, so very rapidly after the crisis launch, and then in November, and we're just doing an update at the moment. So in a sense, what we've seen is actually central banks, as we heard from DG Ronadal, using most of the tools in the toolbox to support their economies during the crisis. What we didn't find is that very few central banks actually directly calibrated these interventions to connect them to green and climate and nature issues. And perhaps that's not surprising. This is a crisis. These measures had to be designed quite quickly, but it showed perhaps that the sort of the reflex for central banks was not yet green. So when you were thinking about a SME liquidity program, that wasn't designed instinctively to support those SMEs that were going to be leading the transition. So I think that's probably when we're thinking, sadly, if we have another crisis, that we need to be thinking about how we make sure that crisis response measures are actually intrinsically dealing with issues around climate risk and green finance. What we have seen, however, is alongside the crisis response, actually an extraordinary pickup. Normally in crises, long-term issues like climate change or green finance could put on the back burner, and we focus on immediate issues. And that hasn't quite happened. And we've also really learned the value of resilience, which has come up already. COVID is a zoonotic disease. It comes from animals into humans, and it's highly likely that biodiversity loss, disruption of nature, exacerbated by climate change, has been one of the triggers for this. So again, I think many of us have been thinking about actually the scale and the impact of climate and nature crises, but COVID has really highlighted that these crises, if we don't take care of them, that they can be systemic and really catastrophic in terms of loss of life, human harm, unemployment, and impacts on economies at a scale which is probably far beyond what we'd be thinking. So I think this question of resilience, and therefore the seeds of how nature disruption and climate change feeds into that, has been very important. Therefore, I think what has been coming out very clearly, again, is green finance is a tool for financial stability in terms of actually responding to these crises on the climate side and also on increasing on the nature side. We've heard examples also about, again, despite the crisis, the acceleration of the use of specific tools, taxonomies, scenarios, stress testing, disclosure requirements, sort of commitments within the G7 and also with China as well to make TCFD mandatory. Again, a major step forward. And maybe on the sort of looking back, just to sort of close by thinking on how our thinking has changed, perhaps in the last year or so. So I think there've been some interesting ones. Firstly, I think the concept of market neutrality, particularly in the way that central banks intervene in markets through asset purchase and liquidity programs, that's changed. And recognizing that classic market neutrality actually gives us a blinkered view of how the market works, and Dimitri, you touched on this, and that actually in the context of market failures, example being climate change or biodiversity loss, we need to adjust that view on market neutrality so that actually we are taking account of these externalities, and actually the interventions central banks aren't unintentionally actually exacerbating the problems of climate change. So I think that's been one intellectual step forward. The second is the theme of double materiality, and I think again, we've been thinking about how does climate risk impact either on individual assets or financial institutions or financial system. Now we're recognizing that the financial system itself, banks or investors themselves create impact, some of it negative, themselves create climate risks. And particularly as a system operator, central banks, the double materiality frame, I think is particularly apposite and particularly appropriate for how central banks think about this, both about the risks coming into the financial system, but also the risks that the financial system is putting on the real economy, and therefore the stability implications of that. And finally, I think maybe we've also learned that green issues, climate change issues, nature issues are not separated from the real economy and are not separated by issues of inclusive growth and inequality. Clearly, many issues have been revealed of inequality during the crisis and exacerbated. So I think, again, joining together the green finance and the inclusive finance agenda, which surely you've been doing so well, I think is now sort of seen to be increasingly important. So that's what we've learned. Where do we go next? Well, I mean, maybe in the short term, we have two big milestones for global policy this year. In the second half, we have COP26 on the climate side, and we have COP15 in Kunming a month earlier in October on the biodiversity side. And I think these are very important milestones for also central banks and supervisors thinking about their road ahead for the next decade, because the next decade really is the important one. We need an investment-led recovery. The green economy sectors, the sustainable economy sectors, as Dimitri said, are great in terms of job creation and innovation. In my country, the UK, we need to increase annual net zero investment alone 5 times this decade from 2020 per annum by 2030. It needs to be 5 times bigger by 2030 than it was in 2020. And the IEA is saying in emerging economies, clean energy investment needs to be 7 times bigger from 2020 per year by 2030. So this is not a smooth transition. This is a rapid scale up in capital. And so central banks need to be thinking about how they're going to facilitate that, both in their risk agenda, but also in terms of being supporting government policy, being coherent with government policy. So maybe a couple of thoughts about how to do that. One would be in the climate arena. So clearly we need to respond to the shocks of climate change, build up resilience, but also clearly we need to get to net zero economies by 2050. And so with you, Uli, and also my colleague, Simon Dickau, we've been promoting this strategy around net zero central banking. Banks, investors, insurers are developing their own net zero plans, but what do central banks and supervisors need to do to be supporting that shift to a net zero financial system? Many things they could do, I think, send a clear signal that actually net zero is not just another scenario, but actually is a desired location, a direction of where you want to go. Adjusting the prudential expectations, as Mangal was saying, we propose that actually all financial institutions should have net zero transition plans as a mandatory requirement from prudential supervisors. Clearly making sure that monetary policies are aligned, both in terms of corporate purchase of corporate bonds, but also interestingly thinking through how the purchase of sovereign bonds, either in a crisis or a normal phase by central banks, how is that aligned with the net zero process going forward? And then there is the just transition element. As we move, sectors and regions will be disrupted by this, high carbon sectors will be affected. And what is the role, particularly in the research role of central banks, to identify potential concentration risks in their economies which governments will need to respond to in terms of reskilling, in terms of regional development, and so on. So that's, I think, on the net zero side, clearly only one part of climate change. And then there's biodiversity. As I mentioned, we are in a broader nature crisis as well. This is something which is developing countries are particularly exposed to because they are particularly reliant on ecosystem services. And there's a new study group, as I mentioned, between NGFS and Inspire. And I think, again, as the world moves, getting hopefully a very strong and forward-looking global biodiversity framework in October at Kunming, I think it's interesting for central banks to think about what role they have in ensuring that their activities are supporting this process. So the first is assessment, again, a bit like I think what Mangal was saying on the stress testing and so on, but just starting to assess the dependencies of their financial systems and the impacts of their financial systems on biodiversity. So that's getting the data, getting the evidence base, that's really important. And then there will inevitably be, at the national level, biodiversity financing plans and strategies and so on, supporting innovative ways of supporting sort of nature positive finance. And again, I think central banks will have a very important role in creating that sort of positive finance agenda. And if I may close, just in terms of Inspire, our next festival, as so-called, we like to make these things fun. We'll be holding that in early December, so after these twin COPs, just to really take stock and think about what's next for the central banks. Thanks very much.
Many thanks, Nick. This was really a great overview of the various challenges facing central banks, but also pointers towards where they should be going. And as you were saying, kind of the initial reaction of central banks was to basically, maybe use very comprehensively the tool set, but not in a calibrated way, and the importance of planning for the next crisis. I actually remembered that we initially put forward this Sustainable Crisis Responses project back in 2019 to do exactly that. And then, as it goes with these projects, we were a little bit slow in getting going, and then we were not planning for the next crisis, but we were in the midst of the biggest one in generations. So we're continuing our world tour. We started in Asia with Ronaldol in Bangkok and Mangal in KL. We have now heard from Dimitri in Cambridge and Nick in London. And now we're moving across the pond to Claire Healy, who is the director of E3G's DC office. And Claire has been very active first in trying to get the Fed and the US financial authorities in dealing with these issues. And as we all know, over the past couple of months, there has been a lot of action happening. And Claire will now give us an insight into what the key advances, kind of the advances that were made, and also where the main challenges are. Over to you, Claire.
Thank you, Uli, and it's really nice to see everybody again on the panel. I'll be brief because we do want to have some Q&A. I will say when we hosted the Inspire seminar we did, I think just before Christmas in the US on sort of what the Fed and other regulators have been doing, we didn't have very much to draw on. I think at that point it'd been a little bit like a desert here in the US in terms of financial regulation around the climate crisis. We did have the CFTC report, which is, I think, still worth a read, and Nick and others presented the toolkit. So that was then. Today, it feels like a very different place to be. I think we've seen a lot more action in terms of financial regulation and more generally on the climate crisis. But to the point about the recovery and how we align recovery responses with the climate action agenda, I think I'd say just a couple of contextual remarks and then sort of what we are thinking about doing here and how we go forward from here. I think you're all aware, like, the Fed's response to the crisis, I think, was very fast with a V and fast with an F. They sort of, I've lost count of the trillions being thrown around, but they sort of mobilized very quickly. I think since, with various different programs, I think since many of the climate groups have been a bit critical sort of how overweighted fossil fuel companies were in some of these corporate bond purchase programs. And there's been analysis that I think there was 46 fossil fuel companies got $828 million from the Main Street lending program, when only sort of 9 clean energy companies got, I think, about 62 million at that point. And I do recall that many of the oil and gas companies lobbying hard to change the rules of those lending programs so they would get access. But in the Fed's defense, like, that was in a very crisis fighting moment. So I think they took the market, as was. But we haven't seen very much, I think, from the Fed in terms of aligning the COVID recovery responses with climate action. I think there is a long way to go on that front, and a lot of learning to be done. I will say we've seen a lot more, there's a lot more good news in terms of integrating climate into their core operations. And I think you've all probably been following sort of the news where we had the executive order and a lot of work at the SEC looking at their rule changes. I think that is the area of focus we are most focused on at the moment. In the run up to Christmas, is SEC changing their regulations and coming out with their advisory note on how to incorporate climate risks, transition and physical risks into the capital markets. I think that's our big push between now and Christmas. In terms of the Fed, I think we've seen a lot better alignment between the Fed and the administration. It feels a lot like before the Biden administration and afterwards. Although the Fed is still very wary of keeping their independence, especially after 4 years of being, I think, in the spotlight under the Trump administration. But we've seen the Fed under Powell being a champion, I think, of fiscal spending. And the debate is now how hot the Fed will let the economy run in pursuit of other policy goals, such as full employment. And they've even weighed in to the discourse on racial and gender-based inequality. So I think, this is not normal times for the Fed. This is not their normal approach. It's the first time they've done such a massive corporate bond purchase program. So I think in terms of when we take stock of the situation and look back on how we now start integrating climate, I think sort of the table has been set, and it's what we do from here. And in terms of looking forward, I would say like 3 things in particular with the Fed and the other regulators. It's the alphabet soup here. So, with the Federal Supervisory Oversight Committee has 12 entities, including the Treasury and obviously SEC and the Fed. So we're looking at each and every one of those and how we work to integrate climate risk. But we are seeing a sort of a step change in how these regulators and supervisors are leaning in to this issue of climate risk, physical and transition risk. And so there's a lot of work and a lot more of an assertive agenda. We're seeing more personnel changes in each of these institutions, where we're having climate hubs, such as the new climate hub led by Kevin Steerer at the Fed, same thing at the SEC. So we're seeing that more sort of hardwired into these institutions, and we're hoping that will come out in sort of more robust rules and regulations. So we're seeing it leaning into, and obviously we're seeing that at the Treasury with Yellen and the team there. And also, I think a large appetite to learn from others also. We know learning from counterparties we've heard on this conversation in Europe and Asia and elsewhere. I mean, the Fed is a unique structure, I think, as we know, with 12 regional banks and 24 branches and a huge sort of research capability. So I think it won't take the Fed long. We know underneath they've been learning and working with different institutions like the NGFS, learning from the Bank of England and the European Central Bank. So I think they've taken in all this information, and from intelligence we're hearing it's working its way through those structures. So I think it won't take the Fed long to sort of catch up even, and maybe even overtake some of the other regulators. That's just on the sort of more broad sort of integrating climate risk. On COVID recovery, again, as I said, when we're not hearing very much that they're willing to go beyond where they're at the moment. They're still very conservative institution. And so we are pushing and trying to socialize more what other banks are doing, including the ECB. We have been working a lot trying to sort of promote the toolkits that we have created with this Inspire program. but there's a lot more work to be done in truth. So I think our focus is the next crisis. I've been hearing lots of other colleagues on this panel talking about not this time, but the next crisis. So I think that's sort of the imperative now. I think we know COVID has showed us how vulnerable, not just, we all are, but the financial system is too, to these external shocks. I think there's better alignment with the financial regulators and supervisors, with the administration, and a lot of the rule changes and a lot of the direction comes from Congress and from the Treasury. So we see sort of more appetite there to sort of hardwire this into the system. And we're promoting, it's still lots of work to do here in terms of pricing risk. We're still a long way from sending the right price signals to the market. In terms of disclosure, it's a lot of disagreement when we get into the detail of what's disclosed by whom and when. And also, we don't have a very good taxonomy here. There's a lot of good rhetoric about green bonds, ESG, sustainable funds, but what that exactly means is as yet unclear. So it's a very ripe and fruitful agenda, I think, across the whole of government to do this. But in terms of the regulators, we're pushing very much that they lead by example. And I think we're looking, as I said, our strategy here in terms of the sort of the market writ large in regulation, pushing to get the SEC rule very robust, laying the groundwork for us sort of, I think, in terms of the Fed and the prudential regulations that we want. It's an area we've got to get a lot more technical, I think. And maybe next year, there may be some personnel, Powell and Quarles are both up for reappointment. So I think then, while they've been champions, I think, of fiscal expansion, they're still, I wouldn't call climate champions. So I think a lot of work to be done, not just now over the next few months, but over the next few years. And I think we'll be drawing a lot on the toolbox and the other outputs that this Inspire network has created. So we look forward to the work. The work goes on from here.
Thank you so much, Claire. I think you mentioned, kind of the preparedness and the next crisis and so on. I think what is becoming increasingly clear, and Nick alluded to that, we don't really have time to waste another crisis. Yeah? So I mean, we really need to get going very quickly. And as you mentioned, Claire, there's still a lot of details to be worked out. But at the same time, there's a very great urgency. And I was actually I've forgotten who that was, but a couple of people at the Green Swan conference recently emphasized that the risk of not doing anything now is actually great. The risk of not doing something now is much greater than kind of doing it slightly wrong. And so I think we clearly need to move towards action. And despite all the uncertainties on operational details, but my sense is that we have, broadly speaking, relatively good understanding of the major issues that need to be addressed. And also we have a toolbox that is out there, and waiting yet another couple of years until we're really sure how exactly to design the best possible policies is probably not good enough. But let me open up for a kind of discussion among the panel. We've had a question from Seema in the chat, which Nick already actually addressed in the chat, but I think it was actually a very important one. So Seema highlighted the importance of double materiality and kind of that this was being kind of difficult to be implemented by different levels. Nick, do you want to maybe give some of the written answer also in speaking? And if you, to the audience, if you have any questions, please put them in the chat and we can pick them up. But Nick, to you.
Yeah, I'm happy to. I mean, I'd be really interested in other panelists' thoughts. I mean, double materiality is one of these new phrases, and we have often too much jargon, and so it's often it's a tricky one. But again, I think so much of the work around sustainable finance over the last 20 years has been about, and essentially, how does environmental risks, physical risks, floods or whatever, or in terms of transition risks, so changing markets and policies, how do they impact on finance, and therefore what does that mean for asset values, stranded assets, institutions, financial systems? And that's really important. But we also know that finance itself is not a passive agency. I mean, a passive part of the financial system, and the way that actually finance is allocated obviously contributes to climate change emissions, contributes to destruction of nature, and also contributes to solutions to climate change, and contributes to restoring nature as well. And that's the impact agenda. So I think whereas sort of TCFD1 was very much on that sort of single materiality, impacts of climate on finance, I think now increasingly recognizing that sort of two-way, and particularly for central banks, that's really important. Because whereby maybe an individual company says, well, why should I care about the impacts I make on others? Central banks, that's really important, because central banks hold the system as a whole. They need to think about the stability of the system as a whole, and actually how the actions of one organization is actually impacting others and having those systemic impacts. So I think double materiality is relatively new. It's quite a European context so far, but I think it's really the frame now for thinking not just for disclosure, but sort of central bank operations, my sense.
Thank you. Clearly, the interdependencies need to be taken into account. I'd like to invite the other panelists to either comment on this question or indeed on any issues that your fellow panelists have touched on. If there's anything you think needs to be corrected, or you want to reinforce, or you want to question. Mangal, do you want to go next?
Sure. Yeah. Thank you. Just maybe 2 points. I think Claire raised this already. I think it is crucial to have some kind of a pricing of carbon. However simplistic it is, however segmented it is, it is going to be difficult to get a harmonious one across the board. But at the same time, there is a need for carbon pricing. Without that, I think the whole industry will start mispricing this risk, and the danger of that is high. So I think that's one thing I would like to highlight. And the other thing, I think I'm not sure about the other regions, but for Asia, this is a critical issue. I think transition risk is really a glaring risk for us in the region, given that this is a region with high degree of climate vulnerability, including, it has been growing rapidly, high population growth, coastline is very significant, all the elements, and this region has really is coming to realize the importance of climate risk more and more every day. So transition is going to be a very tough one. Also, given that a significant part of this is still developing economies, and then we have the fragile states and the in the Pacific and the like. So transition is a very, very tough challenge for this region. Thank you.
Thank you, Mangal. Dimitri, you want to chip in?
Yeah, I mean, I don't think I have much to say that's not already been said, but I just think, one of the things that's that's really important is that this is expressed at all levels, from central banks, from governments, and from the private sector as well, as something that isn't to do with either box ticking or doing the right thing or foregoing growth, whether that's at the corporate level or the whole economy level, to safeguard the future. It's about commercial opportunity and risk management and hedging right now. There is substantial risk of loss of value for those who do not move ahead of the game. This is a time of rapid transition. We know where the inevitable transition is going to take us. And we know the opportunities for moving quickly, but we also know the risks associated with moving slowly. And it's getting and aligning expectations amongst the public and private sector in that direction, recognizing the changing landscape of risks, recognizing that the future won't be like the past, and that change is going to happen quickly, and that if you don't, smell the coffee, and if you think that the old safe sectors are going to be the safe sectors of tomorrow, you stand to be saddled with a substantial amount of risk. And I think that's got to be the framing that's going to take this forward, because that also instills credibility. The private sector and the public sector start to align in seeing this as safeguarding commercial self-interest and economic self-interest.
Uli, I would reinforce that with exactly what Dimitri said. I think we've got to speak the language that, in this case, regulators listen to: stranded assets, climate risks, economic stability, maximizing growth and employment, and stable prices. This is sort of the language of love, if you like, and we have to put our issues in that frame. And the other point I'd say, it is a very, at E3G, we always take a systemic approach, right? So regulators are regulating institutions that make their allocation decisions based on other cues. So, we try and sort of get this virtuous circle, this feedback loop. So I think in terms of like double materiality and the taxonomies that we use, I've just sort of broke my own rule. I sort of have a rule: we don't use the word taxonomy here in Washington, DC, right? If we just call it something else, like classification systems, Americans have less of an allergic reaction. They talk in terms of having mutually intelligent frameworks. And as Seema said in the chat, we're not too far from that, So I think that's an avenue where we could have a lot more alignment. I do agree, Uli, I was not sort of saying, I think we can't wait for the next crisis. And I don't think anyone is suggesting like we wait for the next crisis. I think so much learning and doing and, peer pressure, peer learning is going on sort of in these institutions under the system. But I think we have to, with this toolbox, like bring it into these frameworks in a very robust manner, so we have the framework in place in time for the next crisis. And I would just point out, like, many of the civil society organizations have been doing excellent work on the analysis of some of the actual capital allocation decisions of some of these institutions and regulator, and the Fed, etc., and sort of documenting, despite all the rhetoric, where they're actually allocating their capital. And you can see some of the work, for example, from the Rainforest Action Network. They produce the analysis of the sort of the big Wall Street banks and how much money they are giving to fossil fuel companies, and that's on the increase, despite signing up to net zero Paris pledges. So I think more of work of that nature, I think, really also assists the debate. But I do think, when we pivot forward, and again, we're not thinking now in terms of the next few months, the next few years, what can we get done over the course of this administration and potentially with the new leadership team at the Fed. And I do think we've got a lot more to do, not just on analyzing where the risk sits in the system, but how we minimize and reduce that risk. So we do need a more assertive, I think, activist agenda. And I think the toolkit and what other central banks and these peer group learning platforms, I think, are critical to that.
Thank you, Claire. On taxonomies or classifications, as you want to call them, in Europe and UK, we can use the other word, but I think it's important, as much as we need green taxonomies, we also need very much the dirty ones. And that actually also relates to what you just said. As a matter of fact, even though everyone in finance is now talking about green and sustainable and all the great stuff they're doing, as a matter of fact, we still have huge amounts of capital flowing into all kinds of dirty activities. And as much as we need to increase sustainable finance and redirect finance into these sustainable areas, we also need to very, very rapidly phase out financing of fossil fuel related activities and so on. And the IEA report recently, that clearly should have been the final nail in the coffin of carbon financing. And so I think it is important that we do have these dirty taxonomies and that supervisors really get very tough on that. And I just wanted to also highlight one thing. You mentioned, we need to speak the language of central banks and supervisors and so on. And I couldn't agree more on that one. But I think it's also very important, and maybe that's a bit in the spirit of Ronaldo's keynote speech. I think it's also very important to highlight time and again that central bankers, also supervisors, have a market shaping role. So as much as we need, kind of the risk-based approach, and we need to have each and every actor across the financial sector properly account for climate and indeed, as Nick highlighted, biodiversity risk and also other social we shouldn't forget the S in the ESG. But we really need central banks and supervisors to play a market shaping role. And I think we all agree that there is a lot that they can do. Dimitri also highlighted the need to really have this coordination between central banks and other parts of government. And of course, it hasn't come up, but maybe Ronaldo's speech was the first one from a central banker that I heard where there was not this big disclaimer saying, but the key responsibility rests with governments. And of course, we need governments really to step up, but it should be also clear that we need the financial system to step up, and to make sure that this happens, we do need a very strong role by central banks and supervisors to lead on that, to make sure that this alignment happens. And so we are running out of time. So I think we won't have time for a comprehensive closing round, but I can give 10 seconds to each of you, Mangal, Dimitri, Nick, and Claire. So 10 seconds. If you take 15, it's okay to get one final message across.
Let me pass it on to Nick first, because he hasn't.
I think keep going. I mean, it's extraordinary. I mean, I think stamina and resilience, and recognizing that the next decade is the most important.
Thank you. Dimitri.
Yeah, just one thing that hasn't come up that I thought worth mentioning is people often ask, is green going to be the next speculative bubble? To which the answer is almost certainly yes. There's never been a global technological systemic revolution without a speculative bubble. But, if you take the view that this change is happening and it's inevitable, there's still a huge long-term buy opportunity from investing in clean sectors relative to investing in the sectors of the past.
Maybe I can follow here, because my point is exactly on this, on the other side, on the flip side, that indeed what you're seeing is a huge bottom-up move towards climate ESG from the investor side, from BlackRock to the others, massive amounts of assets under management, trillions of dollars. And they are very much, this narrative of ESG is really gaining more and more traction. So I think if it happens from the investor side, a bit more bottom up, it will be much more, I guess, what should I say, from the endogenous, I guess. And at the same time, there are risks that this could be a bubble, but of course we will have to see whether there is some creative destruction. But that's a very good sign that the whole investor community is actually focusing more and more on this kind of investment.
Yeah.
I'm going to say thank you to all of you. This is the end of our Inspire project, and it's been a pleasure and a privilege to work with you all. I've learned an awful lot from you, but it's I'm going to say the end of the beginning, not the beginning of the end. It's the end of the beginning, and the work is only just beginning, and game on. Let's get going.
Great. Thank you, Claire. Thank you, Mangal, Nick, Dimitri. Ronald has already left us, but also thanks to him. I think this was a really great discussion. We've had a lot of very good points from all of you, and certainly this is the end of this particular project, but it's not the end of the discussion. And as Nick says, we need to keep ongoing to really push this agenda further. And I personally am very upbeat. When I participated in the Green Swan conference a few weeks ago with some of you on this panel, I must say, I found it pretty amazing how the tone has changed, how messages that we've been trying to push for many years are now so firmly entrenched, and not just some, other scholars or so, but really some of the most important people in finance, heading the most important central banks of the world, really have changed tone. And so this makes me quite upbeat. And of course, as Mangal says, there's also a lot of change in the financial sector, but we do need to make sure that this change is really going in the right direction. We also do have all sorts of problems with greenwashing and what have you, and we need to make sure that we're not just talking, but that we're moving really in the right direction. So thank you all very much, and looking forward to continue with working with all of you on this